The Name of the Game is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. Welcome to Steve Savant's Money, the name of the game. Hi everyone, I'm your host, Steve Savant, syndicated financial columnist and money gamer extraordinaire. The United States may be the most insured nation in the world. No other society pays more for protection against risk exposure than Americans. It's the first step towards financial wellness. And on today's show, we're talking about reviewing insurance policies and looking for financial exposure. Reviewing policies should be a foundational cornerstone when you're taking stock of your money. Whether it's your home, car, mortgage, or life insurance, one thing's certain, a review is due. And here to talk about your financial audit is CPA Richard Newman. In the G segment, it's game on as we discuss the basics of risk management. In the A segment, we'll outline some of the policy provisions that can save you real money. In the M segment, our money mentor, Richard Newman, will talk about life insurance. And in the E segment, we'll give you some new ideas on using life insurance because it's more than just protection. Well, welcome to the show, Richard.
Thank you, Steve.
When we're talking about a CPA, talking about policy investigation, audits, kind of doing an analysis, this is really new to me from being in this business for 30 years. Why do you think CPAs and other fiduciaries are coming into this marketplace to help their clients with this kind of information?
Well, I came into the marketplace almost 23 years ago after practicing accounting for many, many years, starting off with the big firms and having my own firm for a long time. And I recognized the need for somebody with technical background to move into the life insurance area because the union of the two professions are so important, and the results when the unions are correct are so powerful. And I believe who better than somebody who's trained to investigate than a CPA trained to investigate some of the nuances of the policies, and are they still good or they're not so good anymore.
Well, there's so many policy provisions. When people are watching our show, they're consumers, they say, boy, I have a homeowner's insurance policy. I have renter's insurance. I have a car insurance. I am bombarded daily on television, radio, online by different companies selling different products. I don't know what I'm getting for. One looks cheaper, but is the coverage the same? When you're looking at policy provisions of different things, let's just take homeowners just for once, because that's kind of a good thing. And I think people appreciate a CPA because you're more dispassionate. You're
Right.
a third party. You're an arbiter of our business. And you kind of look at policies and just do the math and just say, this is what you're getting for bang for the buck. Talk a little bit about the benefits of, let's just use homeowners as an example.
Well, I think using homeowners or any type of insurance in a CPA life insurance perspective, somebody's got to be the quarterback of your team. And somebody with a CPA background probably has that ability to be able to have that knowledge across a vast area. Ours is more specific in the life insurance area, but as it relates to dealing with clients, understanding what those provisions are, understanding what the risks are, to be able to make sure that those risks are properly insured for is very, very important, because just like in the life insurance area, not every agent in the P&C area is just as good in understanding. Are they a career agent, one company? Are they completely independent? And what resources do they have in the P&C area? Quite honestly, especially living in South Florida where I live, the hardest part's getting the contracts, and not every P&C agent has the contract that's available to you in the marketplace.
Well, when you look at something, especially when you're talking about Florida, that must be a whole new universe when you're talking about protecting your home. It's the second largest asset, so for most clients. So when you're talking about that, I always look at the deductible. I don't want to pay any more than I have to. Is that really a good deal to go high deductible? Because I've seen a lot of advisors on on radio and television say, yes, you need to be a high deductible and pay the least amount that you have to.
I think like with any type of insurance coverage, whether it's life insurance, disability, or homeowners coverage, understanding your specific situation is important. If you can't withstand the high deductible, you can't have a high deductible. If you can withstand the high deductible and are willing to take the additional risk on, then you should do that if you can afford to take that risk. I think it's like anything else. I don't care what type of insurance you're buying. It's what is that risk? And am I matching the product that I'm buying to the risk that I have?
Now, in your state of Florida, do you have to have additional issues like flood insurance as an adjunct to your homeowner's insurance?
It's an extra product. You're only required to have it if you live in a flood area. What I didn't know, I changed P&C agents a few years ago. I only thought the only flood insurance that you could buy was from the government. That only goes up to, I think, $250,000. My understanding is, and what I have on my home, is I have an additional flood policy over and above what the federal government allows me to buy, which picks up the difference because it is a maximum benefit in that.
Well, a lot of us are looking at normal issues like homeowners, but I also look at auto, because auto is a big deal. Do you have children driving? Do you have 2 or more vehicles? Do you have recreational vehicles? All these things come with the same kind of question. Now, all my consumers always say, Steve, how high should I go on my deductible? And I like your answer. You say, can you afford a $1,000 deductible, or would that sink you? Talk a little bit about this, because in car insurance, a little different, because people are always looking to say, I don't want to pay any more than I have to, but I really want the proper coverage.
I think getting the proper coverage is correct. Again, what's your situation? Do you have an umbrella liability policy over and above the limits? Are the limits that you purchase consistent with what your car leasing company requires you to have? I look at it a little differently. I look at it more from the risk standpoint. I look at it, many of my clients have kids who are driving. Those kids are driving cars. Whose name are those cars in? Who's insuring those cars? Who's going to create the liability? There's a situation down in South Florida right now, a young man who was high on marijuana was driving his father's car and killed somebody. What planning could have taken place to not expose the parents' assets to that potential liability?
And you mentioned one of them, which was an umbrella policy, and I think people don't really see this overall arching canopy of protection that an umbrella brings. That's additional above and beyond whether you have homeowners or auto in our case.
Absolutely, and what's important there is to make sure that the agent that you're using who does the umbrella understands all the assets that you have. You may have a house in a different state, but this one person's insuring Florida for you. Did you notice that they had that house in the other state? I have a boat. My boat is not insured by my homeowner's policy. It's a separate contract that I now have noted on my excess liability coverage. This way, if there was a potential loss or a loss of life on the boat, God forbid, that would be covered for that as well.
Risk management is really important when talking about finances.
I think, quite honestly, when you really take a look at it, my CPA really places me in a position to understand what those potential risks are. My years in the life insurance industry allow me to be able to provide the products to sustain those risks and to overcome those risks.
If you want more information on how you can obtain a life insurance audit, just email me, steve.savant@ashbrokerage.com. Taking the time to review your policy can save you real money. Is saving money important to you? I'm sure it is. When we come back from the break, Richard and I are going to talk and walk you through some of the policy provisions that can save you real money in the A segment of our show.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life from one of the largest distributors of indexed universal life, Ash Brokerage.
Well, welcome back to The Name of the Game. I'm Steve Savant with CPA Richard Newman. And just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or insurance professional. Coming up in the A segment, Richard and I are going to walk you through some of the policy provisions that could save you real money. Well, Richard, when we're talking about policy provisions, I've noticed, and especially this goes into, because we're going to get into this very deep in the next 2 segments, there's the current company practice, and then there's these contractual guarantees.
Right.
And there seems to be 2 different sets of rates. And sometimes when I'm looking, it's not so bad in homeowners, I know what I'm getting there. It's not so bad in car insurance, renter's insurance, flood insurance. It is what it is. But when I start dipping my toe into things like policies on life insurance for coverage on my life, I've noticed that there's complete 2 sets of rates, and I think that's confusing for consumers. They don't understand that might be able to move.
Well, understanding the moving parts in a life insurance contract is what allows you to understand what the risk is and allows you to understand the type of life insurance policy you're buying. Yes, it is an issue in the insurance industry that far too many people have sold policies looking at the illustration, only looking at the one side which says current assumptions, without giving any credibility to the other side that says guarantees. And you mentioned 2 rates. What they really have is there's a guaranteed rate in the contract, which is exceedingly expensive. Then there's a current assumption rate, which is what they're currently charging and project to charge. Now, the interesting thing in life insurance contracts, what we usually have are 2 areas of risk. That's the interest rate or the dividend rate that's paid in a cash value, depending upon the type of contract. But the other level of risk is the cost of life insurance that the carrier is able to charge you. Historically, the biggest level of risk is in what the carrier is able to charge you, not what they're required to pay you. And most people don't understand that. Most people don't understand how the life insurance contract works, that even though the cost of life insurance as projected per dollar of life insurance may not go up long-term in a life insurance contract, Steve, what may take place is a dividend rate or the earnings rate that was anticipated on that policy from 1991 could have been 8, 9, 10%, but what actually was received was 4, 5, and 6%. That means the cash value didn't grow as rapidly as it needs to be, which that has a very, very detrimental effect to the policy because it requires the company, the insurance company, long-term, to kick in more of their money when you die, and that's expensive.
I notice you're mentioning a few permanent forms of cash value policy. You mentioned participating whole life, which has the dividend, but it's not guaranteed. It could be good, it could be not, we don't know.
Right.
And it's been declining over the last decade for sure. But there's also, I noticed that there is guaranteed universal life that really has a guaranteed premium to it. It actually locks a number down. So you could, if you need a permanent product, I guess you could go that route.
Oh, absolutely, you could. And most of my clients who venture into the estate planning world are looking for certainties as they grow old. And that product's a great product because it becomes impervious to changes that the carrier has available to it. But let's make sure we understand what's guaranteed, Steve. What's guaranteed is the premium and the death benefit. The cash value is not. That cash value can be significantly lower than is anticipated on those illustrations. But if you're buying life insurance merely for death benefit and you're looking for the lowest possible cost without any potential fluctuations, the Guaranteed Universal Life product is a great product. What you have to be careful of is some older variations of those had age 100 limitations, which means either you were dead by age 100 or the policy would die before you without the benefit being paid. Another reason for life insurance policy reviews, to ensure that you've got a contract that will be there when you die.
So if I'm really healthy, this is going to be a consideration. If I have longevity in my family, I need to look at something that maybe goes out. And some of these contracts, I've seen them go out to 120, 121 years. I mean, they're guaranteed.
Absolutely, they're guaranteed. But what's very interesting about those types of contracts that are guaranteed to age 121, Steve, is we don't have to pay for an age 121 guarantee. If I have a person who is 75 years of age that barely got standard, but their life expectancy is not a normal life expectancy, why would I pay for age 121, or if I paid only to age 100, that premium may be significantly lower, where if the medical circumstances changed, we could always increase that premium later in life to project it out after age 100. But why pay for something that has a very minimal chance of taking place? And I see it all the time. Somebody gets diagnosed with a bad form of an illness, their life expectancy is extremely compromised, and they call their life insurance agent without really doing any due diligence on the policy, and they tell them to write the check to pay the premium. When that policy, because of the cash value, may extend for 3, 4, 5, 8 years without paying premium, without degradation of the without degradation of the death benefit. So again, as we progress through life, matching our health with our life insurance policy and what we're paying for is an extremely important issue.
Well, it sounds like, I mean, especially from a CPA point of view, you've not only talked about the policy provisions, now you're talking about the medical profile of the client, which could have a choice in the product that you select. If I'm hearing you correctly, a standard male on the 2001 CSO mortality tables might be looking at age 84. Why would he want to pay and have a contract on the way out to 121?
And again, we would look at that and ensure that there was another funding vehicle to extend it after the fact. But understanding, I mean, let me ask you a question, Steve. You live out here, you have a baseball team out here. Would you pay double the price for a ticket to the game for an 18-inning game versus a 9-inning game when 99% of them only go 9 innings?
Exactly, right, I would.
So why would somebody pay maybe $50,000 for an age 121 guarantee when they're 75 and have cancer, and if they live to age 90, it'd be a long time, somebody pay for an age 100 guarantee that's past where you expect them to be, but significantly less than you would be paying for something that's probably not attainable.
If you want more information on how you can obtain a life insurance audit, just email me, steve.savant@ashbrokerage.com. Taking the time to review your policies can save you real money. Is saving money important to you? I'm sure it is. When we come back from the break, Richard and I are going to go through some of the policy provisions of life insurance and help you save some money in the M segment of our show.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life from one of the largest distributors of indexed universal life, Ash Brokerage.
Welcome back to The Name of the Game. I'm Steve Savant with CPA Richard Newman. And just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or insurance professional. Coming up in the M segment, Richard and I are going to walk you through some of the policy provisions of life insurance that can save you some real money. Well, Richard, I want to continue our discussion, and this is a controversial one, and I have taught here locally at the CPA Society. You're a CPA, you're in this business, you're one of the most prolific writers about life insurance. You do more audits than almost any other CPA I know. When you talk about this, I want to ask you the big question of the day. Term insurance or permanent insurance? I'm always asked this question.
Well, first of all, let's make sure we say audits. I do life insurance audits. I do not do financial audits. I would never be in competition with any of the people that are so kind to refer business to us. I think that's a real good question. And it depends, number one, what's your need? If you can document a need of being 10 years or less, and you buy a policy that's 10 years in a guarantee period, that's great. So I think first thing we need to talk about is what's the need. If this is a need that's going to go on for the rest of your life, it is proven, I can show it to you, putting together Excel spreadsheets, that the most cost-effective way to buy life insurance is in a permanent format. It's just a little bit cheaper in the early years if we buy term. Not a little bit, it's quite a bit cheaper. But as we age, as we grow older, that term goes up in rates much more rapidly than does a permanent contract. So as a result, term is something that is for somebody who's young, who needs the coverage. I was asked to speak to SCORE not too long ago, and young business people opening up that are being counseled by some of the veterans in our world. And they said, Richard, why would we ask somebody to buy life insurance? I said, if a young man is setting up a business that's going to be the breadwinner in their family, they better have coverage, and odds are all they can afford is term. But do I believe that there's a responsibility to do it? The answer is yes. So I believe that the term coverage it's pure coverage. You walk away next year with nothing unless somebody died. You get the right to pay that premium again. Match the number of years in the term to how long you're going to need it, 10, 20, or 30 years. Also, if it's a possibility that you would need that coverage long term, make sure that you buy a product that's completely convertible to whatever product that carrier writes at the time. Some carriers allow for the conversion, but they say you can only go to this product over here, which is double the cost of their off-the-shelf product. But I even hesitate now because there's been so many changes in the life insurance industry over the last few years. This period of low interest rates has been extremely devastating to carriers. You're seeing costs of insurance go up. You're seeing products taken away. In our last segment, we talked a lot about the guaranteed universal. Many companies have taken those away or increased the cost of those very significantly. In the past, I think we could reasonably expect what products would be available down the road when we went to convert those policies.
So if I had a client that has a financial liability, maybe has mortgage, debt, education for his children, and those are ongoing issues, but he can kind of see the end of the tunnel and it's 20 years, you still say, I don't know if anybody really has terminal liability issues, where they just stop. I really don't know. But let's just say if it's an affordability issue. So I could look at a contract that had not only, if I'm hearing correctly, a conversion clause in the policy,
correct,
but it has a good inventory of good permanent policy to convert to.
Exactly.
That's what I heard. I heard you kind of punt on that because it sounds like there's people that they only let you go to this one product and it's not a good product.
And who knows what's going to take place 20 years from now, Steve. We've seen such changes in the products. 10 years ago, I was really reasonably certain that if somebody bought a 20-year term product for me and wanted to convert it, I'd be able to get that product at the conversion at a price that I reasonably could expect. I can't make that statement today. You know, we've had that. I've always had the same question asked about long-term care. When's the best time to buy long-term care? Well, we always used to say the day before you get unhealthy enough to, be able to qualify for it. But what's taking place there? The products have changed so tremendously. You can't get lifetime anymore. They've limited many of your inflation options. They're trying to do whatever they can to get out of the long-term cost of long-term care. They've done it there. They've done it in the life insurance area. If you have a long-term need for life insurance and you can get your life insurance today at a really good rating, a preferred or preferred plus rating, I would do whatever I could to lock in at least the minimum amount of the long-term need that I have. I would not be playing around with term expecting to be able to convert that to a product that you definitely want at that point in time. Those days of being able to project what the carriers are going to have, I believe, are over.
Well, I'm hearing you say that if I have locked down financial liabilities and future obligations, that timeline is going to dictate whether it's going to be term or whether it's going to be a permanent form of life insurance.
Absolutely. And I also suggest that when you're buying any type of life insurance, term in particular, that every company prices it differently. Every company rates you differently. So what I also suggest is that when you buy term from somebody that can write with a plethora of companies, not just one or two, because term especially has differing rates across the board. Is there re-entry? Do they make you qualify possibly to have to convert the product? Should you buy a disability waiver on your policy? What a way to be able to ensure that your life insurance is in force forever if you become disabled when you could afford it the least but need it the most.
If you want more information on how you can obtain a life insurance audit, just email me, steve.savant@ashbrokerage.com. Taking the time to review your policy can save you real money. Is saving real money important to you? I'm sure it is. When we come back from the break, Richard and I are going to walk you through some of the tax advantages of life insurance that may generate tax-free income for retirement in the E segment of our show.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life, from one of the largest distributors of indexed universal life, Ash Brokerage.
Welcome back to The Name of the Game. I'm Steve Savant with CPA Richard Newman. And just a heads up, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or insurance professional. Coming up in the E segment, Richard and I are going to walk you through some of the tax advantages of life insurance that can generate tax-free income for retirement. Richard, we've been talking about different policies at the beginning of the segment. We're talking about, homeowners, renters, auto, flood insurance. Then we start drifting into life insurance, term versus perm. But now there are significant values, tax advantages, and you're a CPA, so I have you on set. Tax advantages for life insurance as an income, maybe even a supplemental income for retirement. Talk a little bit about that, because I think a lot of consumers, this is just coming to them as a new idea. It's been around forever, but it's just really taken a whole new, I would have to say, a whole new way of looking at life insurance.
Steve, I just was asked to speak to the FICPA in South Florida, Florida Institute of Certified Public Accountants, on life insurance, and they asked me what was new, and I said, not a heck of a lot. Things are kind of thinning down a lot. But the taxation of life insurance is a huge benefit, especially given income tax rates going up these days. One of the biggest bugaboos that many of my clients have is paying the rates of tax that they're beginning to pay on their unearned income. It's huge, and there's really not a lot you can do. Well, the way life insurance is taxed in the United States, the cash value grows without having to pay any income tax. You can extract money from that policy by first redeeming your monies to your basis and then borrowing at your basis, and most companies have a wash zero cost loan. So all of the gains are embedded in the cash value of a policy. As long as you die with that life insurance policy in force, all the income tax potential liabilities are washed away with a death benefit. That doesn't mean that there is no estate tax on a death benefit. That's a different tax system. We're talking about income tax right now. So when you understand that that life insurance wrapper is a wrapper that provides income tax protection, and if we're at a state, we're lucky, I'm lucky I live in Florida, that we have no state income tax. But if you live in New York or you live in any of the states that have significant taxation on your unearned income, it wouldn't be out of the way to approach a 50% tax. The question is, and really the arbitrage that we have at life insurance, Steve, is if I know I've got a 50% tax on the income I make, and I have no tax if that income's earned in a cash out of a life insurance policy, but I have cost of life insurance, which is a fraction of what the tax would have been, why wouldn't I want a disproportionate share of my money to be invested in the cash out of a life insurance policy? And take a look at, now you have a plethora of different policies that we can invest in. The safest and most secure is whole life without any term blends. Take a look back. Would your viewers over the last 20 years enjoyed a 6 to 8%, depending upon the company, after-tax rate of return on their monies without the potential fluctuation of stock market risks? You're shaking your head yes that they'd like to have that, Steve?
They love that all day long.
Well, that's what cash value of life insurance
And many
policy
of those
gives.
participating whole life contracts, not all, but many of them have beaten 10-year treasuries over the years. So it's a solid play. But let's talk about this. Let's say people say, yeah, but I'm looking for a little bit more bang for my buck. There's 4 different cash value permanent policies. You have the one you just said, the participating whole life. We have current assumption universal life and interest rate. We have indexed universal life, and then we have variable universal life. They're all different risk tolerance issues, and if the contract, like you said, is set up TAMRA compliant and it's kept in force for the life of the policy insured, which, by the way, I just need to underline that because I'm asked that all the time. Has to stay online. This could be a huge tax advantage, but there's 4 different chassis to choose from.
There's 4 different chassis. But you said one thing about taxation. I want to just focus real quickly, and then I'll jump back over here. That's really important because the mistakes I've seen people make have these whole life policies, and they build the cash in them, and at some point in time, they start to take some money out. And then the policy needs some cash to be able to survive. They say, I'll let it go. And all of a sudden, they get hit with a big tax bill. It's kind of like having a warehouse that you bought for $100,000. It ran to $1 million. You financed $900,000. You didn't pay tax, and then you sold it, and you walked away with $100,000, but your tax liability is based on $900,000. You took the money out before. It's very important that it be managed through an independent professional. But yet, so it's really critical in that circumstance because you could find yourself in a tax pinch if it's not properly managed. On the other hand, it's hugely important, and at the ultra high net worth families, some of which I work with, are really migrating into use life insurance again. It's called private placement, which is a whole nother tale of variable. But we talked about whole life, which is really, I would say, a riskless investment. It's like a CD inside a life insurance contract. You have universal life, which has more risks because the carrier can play a little bit with the mortality expenses, but you have more flexibility than you do in a whole life contract. You've then talked about other products called an index product, which is you're getting a percentage of the gains in the index, but if the index ever goes south, you have no losses. So again, think about this. We got virtually no risk, a little bit more risk, a little bit more risk. And then variable products are really nothing more, Steve, than an insurance company going to a group of mutual fund people and putting together a plethora of mutual funds inside the cash value. They're called insurance dedicated funds. They're called sub-accounts. And you have the ability to utilize those sub-accounts and manage that just as if you manage your own mutual funds in your name. If you, in reality, in that product, the insurance company is saying to you, Steve, we're going to take the risk of the investments and give them to you. If you do better than we do, you'll do better than you would have done in that whole life contract. But on the other hand, just like your mutual fund investments, these sub-accounts have the risk of loss. And that risk of loss is unlimited. There's no floor. So again, the product that's utilized is based upon the flexibility. I would use a whole life product if I knew that person could put the money in. On the other hand, if I've got somebody that's an investment person that's savvy in the market, I may want to utilize the variable product depending upon the level of success that person have. We maybe want to get into a private placement product, which is a stripped down chassis of cost compared to the retail product.
Well, that's our show for today. I want to thank Richard Newman for being my special guest and today's Money Mentor. And remember, you can follow me on Twitter, Facebook, LinkedIn, or just email me, steve.savant@ashbrokers.com. And don't forget what the good Reverend John Wesley once said, make all you can, save all you can, give all you can. I'm Steve Savant. See you next week.